This is Chapter 10, Measuring a Nation's Income Using Principles of Macroeconomics by Gregory Mankiw. I'm your professor, Dr. Matthew Bradbury. Let's move ahead. In this chapter, we'll be asking the question, what is gross domestic product, GDP? How is GDP related to a nation's total income and spending? What are the components of GDP? How is GDP corrected for inflation? What does GDP measure about society's well-being? We've already distinguished between microeconomics versus macroeconomics. Microeconomics, the study of how individual households and firms make decisions interacting with one another in markets. Macroeconomics, the study of the economy as a whole. In linking about macroeconomics, we built some models. Let's see what we can learn from those. Income and expenditure. Gross domestic product measures total income for everyone in the economy. GDP also measures total expenditure in the economy. This is because every good sold is an income for someone else. For the economy as a whole, income must equal expenditure. Every dollar a buyer spends is a dollar of income for some seller. This was represented to us in our circular flow diagram. Our simple circular flow diagram was a depiction of the macroeconomy. It illustrates GDP as spending, revenue, factor payments, income, and also output. Let's look at some of the preliminaries. Factors of production are inputs like labor, land, capital, and natural resources. Factor payments are payments to the factors of production. They come in different forms. Wages or remuneration for labor, rent, remuneration for land, and profit, remuneration for capital. If you recall, we had two agents in our circular flow diagram, households and firms. Households owning and selling the factors of production to firms, in which case they receive income, which is spent on goods and services. Firms hire or buy the factors of production from households and then produce output that they can sell as goods and services in the product market. Here's the simple depiction of the circular flow diagram. Output, goods and services sold, generate revenue. Do note in that upper left-hand quadrant, revenue, the value of all of the output produced, is equal to GDP. All of that revenue is paid out in the form of some cost, whether it be wages, rents, or profits. Thus, the value of output is represented by the value of inputs, wages, rent, and profit equals GDP. These wages, rents, and profit constitute income for households. Income also is GDP. In this simple circular flow diagram, income is spent on goods and services, thereby generating revenue for firms. The sum of all of this spending or expenditure is also equal to GDP. We will talk synonymously about output, income, expenditure as being GDP. This diagram is oversimplified, and once we have the basic understanding of it, we can complicate it slightly to get a more realistic depiction of the flow of income and expenditure through the economy. This diagram has omitted, certain leakages from the expenditure stream. For instance, your gross income is not available to you to spend. Instead, taxes are taken out. This tax leakage from expenditure can be put back into economy because not only do households buy goods and services, but also governments do. After collecting taxes, they can purchase goods and services from the market. This might be new automobiles for the police force, new uniforms for the firefighters, or the salary of soldiers and school teachers. It is also the case that typically individuals are encouraged to save money from their income, not just spend it all on goods and services. That savings then leaks out of the expenditure stream. The savings is not undertaken simply for the act of saving, but to postpone consumption into the future. Individuals deposit savings in financial institutions in hopes of earning an interest rate or rate of return. At some point, they will cash out that savings and transform it back into expenditure or consumption, as it will. That savings does not disappear from the economy. It is not an idle hoard because the financial system is in the business of collecting pools of saving and then lending it out to entrepreneurs who are looking for business investment. The returns from entrepreneurs engaged in business investment is what funds not only the profitability of the financial system, but the interest rate on your savings deposits. The leakage from the expenditure stream is savings, and it's injected back into the market for goods and services as businesses invest. The foreign sector. Not all of your consumption is directed towards domestic GDP. Not all of your consumption is directed towards domestic markets. Imports represent a leakage from domestic GDP. It is the import or purchase of goods and services from abroad. There is a countervailing injection, however, because through the channel of exports, we sell goods to the rest of the world. Let's define gross domestic product. Let's look at this definition in detail. Gross domestic product, or GDP, is the market value of all final goods and services produced in a country in a given period of time. We will break down this definition piece by piece to understand each of its components. If we think of GDP as the market value of all output, we have to ask the question, how do we aggregate or add together all of the things that are produced in the economy? For instance, if I had 2 apples in my economy, my GDP would be 2 apples. If I had 2 apples and 3 oranges in my economy, I would have 5, well, I can't add apples and oranges, can I? I'd have 5 things. If I had 2 apples, 3 oranges, and 1 Ford pickup truck, I would have 6 things. You see, what's happening here is I've aggregated things together, but I haven't weighted them or categorized them in a way that reflects their weight or importance in value creation. For this reason, we must first convert the things, the output, into a numerical term that can be shared by all of the units of output. This is the market price. Goods are valued at their market price. All goods measured in the same units. We'll measure them in US dollars, for example, for calculating the GDP of the United States. In that way, a Ford pickup truck, which might sell for $40,000, is weighted more heavily in terms of value creation in GDP than is an apple that might sell for only $1. This is interesting because although we necessarily must use market prices to add together these different things, these things that don't have market value will not be included in GDP. GDP, therefore, will exclude anything that was not commodified. GDP will be blind to values that are created but which are not sold. Let's look at an example of that. One of them might be the housework that you do for yourself. This housework would be very expensive if you had to procure it on the open market from a cleaning person or a private chef or a laundry shop. You do it yourself and it's not sold. It doesn't create an income. It is value, but it is not included in GDP. In addition to all production that creates value but is not commodified or sold on a market, we can think about natural resources, untouched, unspoiled natural resources. A forest of hardwood trees left to grow is not sold, and therefore it does not contribute to GDP. A forest that is chopped down and turned into toothpicks or dashboards for fine automobiles all of a sudden is included in GDP. The value of untouched natural resources is excluded from GDP, even though we think of it as creating value in life, value in society, and value for future generations. Gross domestic product is the market value of all final goods and services produced within a country in a given period of time. A final good is a good that is intended for the end user. This is taken in contrast to intermediate goods, which are goods that are used as components or ingredients in the production of another good, which will ultimately become a final good. If you think about it, suppose that Ford Motor Company were to sell a pickup truck and that the value of that pickup truck were $40,000. In the process of making that pickup truck, they may have purchased 4 tires from Firestone Tire Company. If we looked at the value of the tires when purchased from Firestone and took that value and then added it also to the value of the final Ford pickup truck, we would have counted the value of the tires twice. In order to avoid double counting, we only consider final goods in the calculation of GDP. GDP only includes final goods. They already embody the value of intermediate goods that were used in their production. Gross domestic product is the market value of all final goods and services. GDP includes tangible goods, DVDs, mountain bikes, beer, and also intangible services, dry cleaning, concerts, cell phone service, and the like. GDP is the market value of all final goods and services produced within a country in a given period of time. GDP includes currently produced goods, not goods that were produced in the past. GDP is the market value of all final goods and services produced within a country. GDP measures the value of production that occurs within a country's physical borders. It doesn't matter whether or not the production or the value creation was done by its own citizens or by foreigners working on domestic soil. Irrespective of nationality, GDP adds up the value of output, the value of production that takes place within the physical borders of a country. GDP is the market value of all final goods and services produced within a country in a given period of time. We can choose the time frame by which we'd like to measure GDP. Usually, we see it quoted over a year or over a quarter. Let's go ahead and break down some of the components of gross domestic product. GDP might be calculated as the value of output, the value of income, or the value of total spending. If we think about total spending, which we often refer to as total expenditure, it generally has 4 components. The first is consumption. It will be indicated by the letter C. We'll talk about consumption in a moment. It's what households are doing in the market for goods and services. Secondly, we have investment, which will be indicated by the variable I. This will be purchases of goods and services by firms. In addition to households and firms, we also have government purchases, indicated by G. And also, in our interaction with the rest of the world, we will have net exports. Net exports will be defined as the exports that we sell, which therefore contribute to domestic expenditure, minus the imports that we buy, which detract from domestic expenditure. Net exports is best thought of as exports minus imports. These components together add up to GDP. We will denote GDP in this class with the letter Y. Here we have an expression that says Y, or output, or income, or GDP, is equal to expenditure. The components of expenditure: consumption, investment, government spending, and net exports. Let's take a look at each of these in a little bit more detail. Consumption. Consumption is total spending undertaken by households on goods and services. Note on housing costs: for renters, consumption includes rent payments. It's like a service that you're purchasing. For homeowners, consumption includes the imputed rental value of the house, but not the purchase price or mortgage payments. As it turns out, these will be included in investment. Business investment, I. Investment is total spending on goods that will be used in the future to produce more goods. Included in investment expenditure is capital equipment. These are the machines and tools that are used to produce and sell in a business. Structures, factories, office buildings, and houses. Inventories, goods produced but not yet sold. The inventory is interesting. It requires a little bit of extra explanation. When we think about it, a firm had paid workers to produce output. Therefore, that output has generated an income. If the output is not sold on the market, it is retained as inventories. This would lead to a discrepancy between total expenditure and total income. So what we do is we treat the inventories as if the firm purchased them from itself. In this way, expenditure accounts for unsold inventory accumulation and will allow us to equal out expenditure with the income that was derived from producing these inventories. Take note, investment does not mean the purchase of financial assets like stocks or bonds. In the common parlance, we say, I'm undertaking some investments when we buy stocks or buy bonds. But this is inaccurate from an economics class perspective. We have different terminology that we try to use more specifically. When you purchase a financial asset, what you're doing is saving. You're diverting from consumption to purchase an asset that you hope will gain in value. At some point, you wish to sell that asset and use the returns for consumption. Purchasing a financial asset such as a stock and a bond is just a way of purchasing a saving instrument, a place to park your wealth until you wish to use it. Investment, however, is when businesses purchase plants and equipment, structures, or inventories for the purpose of generating profit, generating cash flow. Investment is a productive endeavor. Saving is merely parking your funds in a financial asset where someone else will use them in a value-producing endeavor. And that's where your rate of return or interest will come from. Keep in mind, in this class, saving is the purchase of stocks and bonds, and investment is spending on capital equipment, structures, inventories, and the like. Government purchases. Government purchases is all the spending on goods and services purchased by governments. This might be at the federal level, at the state, or the municipal level. Government spending will exclude transfer payments. Transfer payments such as Social Security or unemployment insurance benefits, these are not value creators. They're not new value created. It's income derived elsewhere that has been redistributed, and therefore it doesn't add to GDP. When we think about government purchases and their relationship to income, we can think about all of the income that was derived by workers and private contractors for building and maintaining our public roads, building schools, hospitals, bridges. All of the above and many, many more categories are included in government purchases. This is oftentimes referred to as the public sector. Net exports. Again, net exports is our interaction with the rest of the world, buying and selling goods abroad. Net exports is equal to exports minus imports. Exports represent foreign spending on the domestic economy's goods and services that are sold abroad. Imports are the portions of consumption, investment, and government spending that are spent on goods and services produced abroad. Once we've added up all the components of GDP, it gives us GDP, or Y, is equal to C plus I plus G plus net exports. GDP, or Y, is equal to household consumption, business investment, government purchases, and net exports. Let's go ahead and look at GDP and its components for 2010. Keep in mind that these numbers are in the billions. GDP, or Y, in 2010 was $14.7 trillion. Consumption, $10.4 trillion. Investment, $1.9 trillion. Government expenditure, $3 trillion. And we ran a trade deficit. Our net exports was negative $550 billion. What this indicates is that our exports were less than our imports. We spent more abroad than we sold, and therefore the net export figure is negative. Looking at these numbers, we can see a couple things. Not only were we running a trade deficit in 2010, but that the largest component of GDP, the largest component of expenditure, is by far and away household consumption. If you've heard the U.S. economy referred to as a consumer economy, this is the kind of fact that backs up that kind of statement. If we look at these categories of expenditure as a percentage of GDP, we can see that consumption is 70.3% of GDP. This figure and this proportion is typical for U.S. GDP. Consumption typically makes up over 2/3 of total GDP. Investment was 12.9% of GDP, and government spending, fairly large contribution to GDP, 20% of GDP. If we take U.S. GDP and we divide it by the population, what we've done is calculate per capita GDP. Keep in mind, this sort of calculation would be an even distribution of GDP equally across all members of society. Per capita GDP in 2010 was $47,459. That's per person GDP. Now keep in mind that in general, countries with higher GDP will typically have higher GDP per capita. But the reality of most countries is that we don't distribute GDP evenly across all members of society. GDP per capita does not give us an accounting for the amount of inequality in an economy. Obviously, certain individuals will make far more than $47,000 a year, and some will make less. Let's do a learning check and see how we're doing. GDP and its components. In the following exercise, what we want to do is try to figure out how each of these forms of expenditure would be categorized in our C plus I plus G plus net export framework. Let's get started. Debbie spends $200 to buy her husband dinner at the finest restaurant in Boston. Sarah spends $1,800 on a new laptop that she's going to be using in her publishing business. Keep in mind, the laptop was built in China. Jane spends $1,200 on a computer to use in her editing business. She got last year's model on sale for a really good price from a local manufacturer. General Motors builds $500 million worth of cars, but consumers only buy 470 million worth of them. How do each of these forms of expenditure compute in our framework for GDP? I'll give you just a moment to think about it. Let's go ahead and reveal the answers. Debbie spends $200 to buy her husband dinner at the finest restaurant in Boston. That's pretty straightforward. Looks like household consumption and GDP will rise by $200. Sarah spends $1,800 on a new laptop to use in her publishing business. The laptop was built in China. Sarah's investing in her business. Investment increases by $1,800. Net exports fall by $1,800 because the good was imported. Thus, GDP is unchanged. Jane spends $1,200 on a computer to use in her editing business. She got the model from last year on a great sale price from a local manufacturer. Current GDP and investment do not change in this case because this is not current production. The computer was built last year, and if it was unsold last year, we would have still counted it last year as inventory accumulation. We can't count it again a year later. D. General Motors builds 500 million worth of cars, but consumers only buy 470 million of them. Consumers would have bought 470 million worth of cars, so consumption is going to increase by 470 million. But what about the remaining 30 million in unsold cars? Well, these are sold to the firm. Remember, we categorize those as inventory investment, and so the full 500 million will be accounted for in our expenditure. In both macro and microeconomic analysis, it's really important to be able to understand the distinction between real and nominal variables. Real variables are measured in terms of quantities. They're tangible things, the amount of labor hours, the amount of output produced, so on and so on and so forth. Nominal variables are typically monetary in their structure. Things like prices or the amount of money in your bank account. In looking at the difference between real and nominal variables, we want to really drive home the idea that it's real variables that matter. For instance, if you have $500 in your bank account, how happy are you? The only way to answer that is to know how many goods and services you could purchase with that $500. For instance, if you're in love with shoes and shoes are $100 a pair, then that $500 in your bank account represents 5 pairs of shoes. On the other hand, if there's been some inflation and the price of a pair of shoes goes up to $250, then the $500 in your bank account is really only worth 2 pairs of shoes. So we want to be able to distinguish between real and nominal variables. When we are calculating GDP, you'll remember in our definition that we looked at the market value of all final goods and services. This market value is a price variable. Inflation can distort economic variables like GDP. So we actually have 2 versions of GDP. One of them allows us to account for inflation. That's real GDP. And one of them includes inflationary trends. That's nominal GDP. Nominal GDP values output using whatever the current market price might be. Even if that market price is higher and higher year after year, we don't account for that. Nominal GDP is not corrected for inflation, and so it's going to include not only real goods and services, but rising prices. Real GDP values output using the prices of a base year, a fixed base year. Real GDP is corrected for inflation. The idea here is that real GDP will wash out price movements so that the value that we've calculated represents only the new value of goods and services produced in the economy and not inflationary trends. Let's go ahead and look at an example of this. I just want to drive home this idea. If you're reading in the paper and it says GDP in the United States was up 2.1%, even though it doesn't say they're talking about real GDP, they are. It's a convention. If, on the other hand, they were discussing nominal GDP, they had better specify that. Otherwise, they're not a very good journalist. Here's a simple example. We're going to be looking at the GDP of an economy. The economy is going to only have two goods, pizza and lattes. We're going to be looking at GDP and calculating it over the span of a year, and we're going to look at it over 3 years, 2011, 2012, and 2013. In calculating GDP, we want to find out, well, what's the value of output produced in this economy? We have output, which is Q. The output of pizza was 400 units of pizza in 2011, 500 units of pizza in 2012, 600 units of pizza in 2013. We need to calculate the value of pizza, and so we're going to need to know the price of pizza. In 2011, the price of pizza was $10. As we move into 2012, the price of pizza goes up to $11, and in 2013, it goes up again to $12. Notice that the price of pizza has been rising. Let's look at lattes. Q again reflects the real quantity of lattes that were produced. In 2011, it was 1,000 units of lattes. By 2013, our output of lattes increased to 1,200 units. The price of lattes in 2011 was $2, $2.50 in 2012, and $3 in 2013. There's also been some inflationary trends in lattes. Now, we've seen a growth in output of pizza and a growth in output of lattes, but we've also seen prices rise. Let's go ahead and calculate nominal GDP for each of our years. In calculating nominal GDP for each of our years, we will value output at whatever the current market price is. 2011, the market price of pizza was $10, and we'll multiply that by the 400 units to get the total value of pizza production. We will then add that to the total value of latte production. We produced 1,000 lattes and sold them for $2 a piece. Collectively, our GDP, the total market value of all goods and services produced in our little economy, is $6,000. In 2012, we'll do the same thing. The market price of pizza was $11 and we produced 500 units. We're going to add that market value of pizza to the market value of lattes. We produced 1,100 lattes and sold them for $2.50 a piece. Adding together these market values provides us with $8,250 of GDP. In 2013, well, pizza was $12 and lattes were $3. If we add up the market value of production, we get $10,800. Let's now compare GDP in 2011 with 2012. GDP increased from 6,000 to 8,250. This is a 37.5 increase. From 2012 to 2013, GDP increased 30.9%. That's astounding, and it's because we're using such simple numbers here. The increase, 37.5% from 2011 to 2012, and 30.9% from 2012 to 2013 reflects not only the fact that we have more pizza and more lattes in subsequent years, but also the fact that output is becoming more expensive. Now, when we get more real output in the economy is more wealthy. There's more goods and services to go around, and less scarcity. We like strong growth in real goods and services. But inflation, or price increases, erode the value of money. Nobody likes that. We want to be able to distinguish whether or not the growth in these numbers was coming from a bad, like inflation, or a good, like increased production. In order to do so, we need to get rid of the price movements that are causing our numbers to grow more rapidly than the increase in output. In doing so, we're going to be calculating not nominal GDP, as we've done in this slide, but real GDP. To calculate real GDP, we want to eliminate price movements, basically just assume them away. For this reason, we're going to choose a year, any year, and fix the price vectors to the prices that were occurring in that year. Once we've chosen a year, and it's arbitrary what year you choose, we refer to it as the base year. We will then use base year prices in valuing real GDP or real output in all of our subsequent yearly calculations. We've chosen 2011 as our base year. Let's calculate real GDP in 2011. The price of pizza in 2011 was $10. The quantity of output was 400 units of pizza. This is the market value of pizza output in 2011. The price of lattes was $2 and the quantity was 1,000. Multiplying these will give us the market value of latte production in 2011. And in 2011, our calculation of real GDP is 6,000. Take a moment. Our calculation of nominal GDP for 2011 was also 6,000. This is because we've used the same prices in both of our calculation of nominal and real GDP. The reason that our price vector for 2011 is the same for real and nominal GDP is that we've chosen 2011 as the base year. Let's move ahead to 2012. In 2012, pizza production increased to 500 units. We're going to multiply that 500 units by $10. This is because we're using 2011 prices as the base year, and we will value all subsequent year output using that fixed set of base year prices. So, in valuing the pizza production in 2012, we let the quantities change, but we keep the prices fixed. You'll notice that in 2011, in 2012, and in 2013, we see that $10, $10, $10, and that is the price of pizza in 2011. Calculating real GDP gets easy because once you find the base year, you don't have to look for any more information. If we're looking at lattes, the base year price was $2, and in 2011, 2012, and 2013, we're going to use that price of $2 to evaluate the value of output. The output here for both pizza and lattes is allowed to vary to reflect the growth in real production that's been taking place over time. In 2012, we use 2011 base year prices of $10, multiplied by the quantity of pizza, 500 units, add that to the base year price vector for lattes of $2, multiplied by the quantity of latte production, 1,100 units, and we arrive at a real GDP calculation of 7,200. This number is lower than our nominal GDP. How come? Because we're not including upward trends in inflationary data in our calculation. Once we've calculated real GDP using our base year prices, we can look at the rate of change between each year. From 2011 to 2012, we saw a 20% increase in real GDP. This is a 20% increase in real economic output, real economic activity. It reduces scarcity and grows material wealth. From 2012 to 2013, the increase in real GDP was 16.7%. Keep in mind that these percentage changes are smaller than that reflected of nominal GDP because these percentage changes include only growth in real output and not inflationary data. Let's compare our nominal and real GDP calculations. In 2011, nominal GDP was $6,000. In 2011, real GDP was $6,000. Keep in mind that nominal and real GDP will always be the same in the base year. In 2012, nominal GDP was 8,250 and real GDP 7,200. In 2013, nominal GDP was 10,800 and real GDP was 8,400. In each year, nominal GDP was used nominal GDP was measured using the current market prices at the time. Real GDP, again, measured using constant market prices from some chosen base year. Here we see our comparisons between nominal and real GDP again. Again, those changes in nominal GDP, 37.5%, 30%, reflect both price changes and quantity changes. For real GDP, the change was 20% and 16% over time, reflects only changes in the amount of real production taking place, i.e., as if there was zero inflation. For this reason, real GDP has corrected for inflation. We can look at a graph of real GDP and nominal GDP over time. Here we have real and nominal GDP plotted for us. It's for the United States over the period 1965 to 2010. The red line is real GDP. The blue line is nominal GDP. Keep in mind that real GDP was calculated using a fixed set of prices from the base year. That base year was 2005. What can we see or discern from looking at this graph? First off, you might notice that the slope of the nominal GDP line is steeper than the slope of the real GDP line. Why would nominal GDP be growing faster than real GDP? The answer is that nominal GDP includes upward pressure in prices as well as growth in output. For that reason, it'll move faster, grow faster than real GDP. Secondly, at some point in the mid-2000s, it looks like nominal GDP crosses real GDP. What might explain that switch point or cross point? Well, I bet that occurs at 2005. At 2005, real GDP would be equal to nominal GDP. They would have the same value. And this is because we use 2005 prices to calculate our real GDP. Lastly, note that the lines switch. They hit a cross point at 2005. We've already said that we think that's where the base year is. What might explain that cross point? Well, if we go back to 1970, we would be calculating real GDP using prices from 2005. Those prices would be much higher than the current prices in 1970. For that reason, nominal GDP would look smaller than our calculation of real GDP. After 2005, prices probably continued to spiral upward, and so the calculation of nominal GDP is using higher future prices than that which occurred in 2005. Each of these things, each of these aspects can be pulled from a quick read of the graph. The GDP deflator. We have nominal and real GDP. One of those calculations includes information about prices and also quantities. The other, real GDP, includes information about only quantities. We can use these two measures to back out what's happening with prices alone. The GDP deflator is a price index. It's a way of organizing data into a convenient fashion, and it's our first price index that we'll look at. In the next chapter, Measuring the Cost of Living, We'll calculate and develop some other price indexes, such as the CPI and the PPI, but here we're able to start getting into price indexes through looking at the GDP deflator. The GDP deflator is a measure of the overall level of prices. How can we define the GDP deflator or calculate it? Well, the GDP deflator is the ratio of nominal GDP to real GDP, then multiplied by 100. Do keep in mind, nominal GDP included P and Q. Real GDP included only Q, changes in quantities. PQ over Q, well, the Q's wash out and we're left with price data. Our index or our deflator is a way of organizing the level of prices through time. One way to measure the economy's inflation rate would be to compute the percentage change in the price level from one year to the next. Here, we're using the GDP deflator to measure that price level. If you need to take a moment to write down the equation, do so. We're going to be using it in subsequent slides. Let's calculate the GDP deflator. Here we have each year, 2011, 12, and 13, nominal GDP calculated in each year, 6,000, 8,250, 10,800. Real GDP calculated for each year in the third column there, 6,000, 7,200, 8,400. And below our first table, we're going to calculate the GDP deflator. Remember, the GDP deflator is nominal GDP over real GDP multiplied by 100. Let's calculate it for 2011. Nominal GDP in 2011 was 6,000. We'll divide that by real GDP for 2011, which was also 6,000, and multiply it by 100. Our GDP deflator for 2011 is 100. Keep in mind that 2011 was our base year. Nominal and real GDP are always equal in the base year. For that reason, the GDP deflator for the base year will always be 100. Calculating the GDP deflator for 2012. Nominal GDP in 2012 was 8,250. We will divide that by real GDP in 2012, which was 7,200, and multiply by 100. The GDP deflator is 114.6. Calculating the GDP deflator for 2013, we have nominal over real GDP for 2013. This is 10,800 divided by 8,400, and then multiplied by 100 to create our index number. The price index, according to the GDP deflator for 2013, is 128.6. We can calculate the inflation rate by looking at the rate of change in the price index. In 2012, the GDP deflator was 114.6. In 2011, the price index was 100. You can see that we've had a 14.6% increase in the price index, a 14.6% increase in our price level. Inflation from 2011 to 2012 was 14.6%. We can also calculate the rate of change of the price level, or inflation, between 2012 and 2013. In 2012, the price index was 114.6, and it increased to 128.6. This is a 12.2% increase in the price level. Inflation from 2012 to 2013 is 12.2%. Thus far, we've calculated nominal GDP, real GDP, and the rate of change in real GDP, otherwise known as economic growth. We've also calculated the GDP deflator and the rate of change in the GDP deflator, which is otherwise known as inflation. That's quite a lot. You've done a good job. Let's move forward to some conceptual material discussing gross domestic product and economic well-being. GDP and economic well-being. Real GDP per capita is one of the main indicators of an average person's standard of living. But GDP is not a perfect measure of well-being. Robert Kennedy issued a very eloquent yet harsh criticism of GDP. It's also a criticism of using GDP as the only or sole measure as to whether or not a public policy should be undertaken or not. Robert Kennedy is essentially saying that the test for good policy should include GDP, but certainly not be limited to GDP, because the well-being of society includes GDP, but is not exhaustively calculated by GDP. Let's look at what Robert Kennedy said. Gross domestic product does not allow for the health of our children, the quality of their education, the joy of their play. It does not include the beauty of our poetry, the strength of our marriages, the intelligence of our public debate, or the integrity of our public officials. It measures neither courage, nor wisdom, nor devotion to our country. It measures everything, in short, except that which makes life worthwhile. And it can tell us everything about America, except why we are so proud that we are Americans. GDP leaves out the quality of the environment. It leaves out your leisure time. It leaves out non-market activity, such as childcare. It leaves out an equitable distribution of income. Each of these might contribute to your well-being and the well-being of society. So if GDP is not an exhaustive measure of well-being, why do we care about GDP? Well, as it turns out, GDP is correlated with a lot of quality of life indicators. Having a large GDP enables a country to afford better schools, a cleaner environment, healthcare, so on and so forth. Many of these indicators of quality of life are positively correlated with GDP. Let's look at a couple of. Here we have GDP and life expectancy, 12 countries. The U.S., our GDP per capita, upwards of 40,000, with strong life expectancy, contrasted to Nigeria or Bangladesh, much lower real GDP per capita, and also lower life expectancy. GDP and literacy in 12 countries, the U.S. again coming in at the top of that graph, and you can see a pretty interesting correlation between GDP per capita and literacy rates. GDP and internet usage in 12 countries, a very strong correlation between real GDP per capita and the infrastructure to generate internet usage. In summary, gross domestic product, or GDP, measures a country's total income and total expenditure. The four components of GDP, or expenditure, include household consumption, business investment, government purchases, and net exports. Nominal GDP is measured using current market prices. Real GDP is measured using a fixed set of prices from a base year. Real GDP corrects for inflation. GDP is the main indicator of a country's economic performance, even though it's not a perfect measure of a country's well-being. I hope you enjoyed your slides. We'll see you again next lecture. Have a nice day.